Well, in the last 2 years, you pick up any major research report, all of them getting centered around expectations of a very strong growth in India's insurance sector. Now, two important things to note here. A, this sector is already growing at about 15 to 18% each year. And B, it's not a small sector by any means. Just in FY24, the insurance companies in India collected a total premium of 7 lakh crore. Now, as far as the reforms are concerned, there's another very common thing amongst the research reports coming out. They all list the regulatory reforms in the last couple of years as one of the top 3 reasons driving this change in the industry. Today, with us is the man behind, a lot of these reforms which have brought such strong changes in India's insurance industry. Mr. Debasish Panda, the Chairperson at the Insurance Regulatory and Development Authority of India. Mr. Panda, first of all, thank you so much for joining us on this very important day at the stage of Global Leadership Summit. CNBC-TV18 completes 25 years today, and a very good day to have you to have this interaction today. Thank you so much, first of all.
So, thank you very much, Yash. For having me here today, this morning, and my apologies, I couldn't make it in person to Mumbai, but I would like to also welcome the viewers today who are watching this show. I think I should first of all thank you for understanding and appreciating the changes that have been brought around in the insurance sector. I think if you look at the Indian context, yes, the market is growing. Insurance, there is a felt need for insurance even growing also across sectors. And therefore, and it's also true that insurance was a low priority need. But in recent times, we have seen that there's a rise in the per capita income, the middle class is widening, the purchasing power has got enhanced. The millennial population who understand risk and insurance better are keen to buy insurance. All of this also has led to the share in the discretionary spend increasing. And that is benefiting also in terms of spending in financial products, which includes insurance. We have also seen that the sector has got, particularly the health sector or the health segment, further impetus by the COVID-19. Overall, the financial awareness is on the rise. Yes, much more to do, but yes, it is on the rise. Now, the second thing that is happening, what is or necessary to be done, is that the industry now needs to harness the economic and the demographic shifts, and also simultaneously you have to instill trust in insurance in the minds of the policyholders or the prospects. And that could be only done by creating a delightful experience for the policyholder. I mean, it should start right from the solicitation till the settlement of claims, the entire life cycle of the product. So what have we done? What was necessary to be done was to facilitate the insurance sector to create such an experience. The regulatory framework has been made more enabling and more supportive. And the foundation of insurance for all rests on making it available, making it accessible, and also, most importantly, making it affordable. So how we have done this, I would actually put it in 4 blocks. Allow me to answer this question so that the context or the perspective is set. So what we did was we divided our goals into 4 building blocks. 1, to refine the present. 2, leverage technology and data. 3rd, how do we reach out to the last mile, the last household and the last person? And how do we make ourselves future ready in order to achieve the vision of insurance for all by 2047? So when I say refining the present, from a rule-based regime to a principle-based regime. So a 360-degree evaluation was done, and that revealed that there were very strict boundaries, a lot of redundant approvals, prior approval requirements from the authority, and a myriad of compliances. So what we did was a regulatory revamp through a very, very extensive participative and collaborative approach. And then that resulted in coming up with progressive, forward-looking, and a principle-based architecture has now been put in place. And you would have seen that from, it was 100, 120 earlier, now 78 regulations were in existence, and now that has come down to 20. So the 20 regulations, out of those 20, 15 are the ones which are, deals with the operational issues as far as the insurers are concerned. The remaining 5 is internal to the organization, that is the IRDAI. More than 375 circulars have been repealed and more than 80 returns have been rationalized. So the pillar rests on ease of doing business and also reduction of compliance burden to the extent possible. So what we have done is, beginning from the entry of an entity into the sector, launching of products, managing operation and expenses, improving distribution efficiencies, reducing compliance burden, to raising capital, each and every aspect of insurance business has been streamlined, made more efficient, made more effective. And the results are evident. You would have seen that 6 new insurers have come in the last 2 years. There are a few in the pipeline. And these 6 have come after a hiatus of almost 12 years in the life segment and around 4-5 years in the general and the health segment. Now, this is the first building block, refining the present. I'll come to the second building block, which is leveraging tech and data. Now, you have to promote innovation, you have to be efficient, you have to have the reach and also the scale. So here, the big game changer or the defining moment for the insurance sector would be the Bima Sugam. The Bima Sugam will change the face of insurance, which is because it's an electronic marketplace which will be going to the doorstep of every customer. Now, not just that, we are also looking at making the Insurance Information Bureau, which will not remain just a data repository, but it will be a center for data analytics and advanced data analytics. Going forward, in personalized and hyper-personalized offerings can also be done through this framework. Then we have also moved to a revamped regulatory sandbox where innovation will be promoted in a big way. Now it is 24/7, 365 days in a year, and the experimentation period has also been enhanced to 3 years. We have an InsurTech monthly open house just to encourage new fintech and InsurTech players to find suitable partners for testing and mainstreaming their solutions. Then, last but not the least, we have also allowed additional expenses of management for tech adoption. So now, reaching to the last mile, the third pillar, reaching the last mile, last house, last person, we have created a framework where a community-centric and women-centric workforce, distribution force will be raised, who will be known as the Bima Didis or the Bima Vahaks, and a base product to begin with called the Bima Vistar, which will be a bundle of life, property, hospi cash, and the fourth element is a personal accident element. So we will be further, there will be more Bima Vistar-like products for unorganized segments like the small traders, the grocery store owners, the gig workers, the farming community. Then the next important thing is that we are trying to bring in the state insurance plan. And the focus will be more of a phygital approach. There needs to be a physical presence, alongside you need the digital platforms also. So, and for the rural business and insurance awareness, we have also allowed an additional EOM allowance. So this is the next pillar. That the other one is also to being future ready and also globally competitive. This is another building block that I would take just 2 or 3 minutes. So while we are doing all of this, making a principle-based architecture, which means we are reposing a lot of trust and confidence in the boards of the insurance companies. We have come up with a new governance framework so as to maintain a strict check and balance as far as the management and the board is concerned, in order to go for good market conduct, maintain the financial stability, and build resilience into the insurance entity. So to make the industry more resilient, more robust, more agile, more prudent, we have now a new framework of capital is being work is in progress for creating this new framework. Currently, from the the factor-based solvency, we will be moving to the risk-based solvency regime. Similarly, we are in the path of also, risk-based solvency. So we are on the path of also going to align with the international financial reporting standards. And you would be aware recently, the Ministry of Corporate Affairs have already, notified the Ind AS 117 guidelines. And last but not the least, we are also moving towards a risk-based supervision framework from the current, rule-based compliance to a risk-based supervision framework. So we are going to have an enhanced risk management framework, which will be more robust, which will be monitoring on a continuous basis, and it will also make sure that early warning signals are also raised, red flags are raised, so that if there is a shock, then they remain resilient and the stability is maintained at all times. So these are all at a very advanced stages of implementation, and we are taking the industry on board so that there is no communication gap, and we are fully aware of what is going to come in the future. So this, I think, will further stabilize the financial sector, particularly the insurance sector, in terms of its the framework that is being created. Then last but not the least is the policyholder-centric approach. Yeah. Would you like to intervene now?
No, yes, go on.
Yes, I have the last point I was trying to make is the policyholders first approach. So we are trying to drive across the insurance industry that the approach has to be policyholders first. So a variety of things have been done in each of the master circulars, whether they are pertaining to life insurance, whether they are pertaining to health insurance or general insurance, right from empowering the customers in terms of the customer information sheet or the benefit illustrations customized or the suitability analysis, the extended free look period, the reduced waiting periods in the case of health, faster and seamless portability, then the flexibility for no claim bonuses. All of this have, and then also having very strict turnaround times for the settlement of claims. So these are all, with a focus on the customer ease and frictionless journey for the customer, and also to create a positive insurance experience for them, and alongside build trust in insurance as a product. So this enhanced trust would propel more people to seek insurance solutions. That is what we believe, and transform this from a push product, from a pull product to a push product. Sorry, I reversed it. From a push product to a pull product, right? So I think all
absolutely,
this will be the key to achieving insurance for all. So therefore, this is the framework on which we have worked tirelessly for the last 2 years, and I must give full credit to the entire team at IRDAI who have put their heart and soul behind it, and we have been able to accomplish what we have done and what you were just mentioning in a very reasonable period of time of around I would say around 24 months. All of this has been put in place. Thank you.
Correct. Chairperson, sir, very extensively you spoke about how, where you want to place this aspiration of insurance for all by 2047, the 4 important pillars. What I want to ask you is on the criticism side as well. There's a lot of criticism, of course. There are, of course, things like, 60% of the healthcare expenses still happening out of pocket in India. More than half of the vehicles still not having a valid motor insurance policy, accident insurance policy probably being the last priority for small and medium enterprises. What would be that one line that you would want to, tell your critics or the skeptics here of this aspiration of insurance for all by 2047?
First of all, we have to be aspirational. We are a huge country with a population which is young. So we have to have aspirational targets and goals. But as I just answered, why we are confident that we will be able to achieve what we should be achieving, that is insurance for all by 2047. We have worked to a plan, we are working to a strategy. So the ones I explained just now, those 4 pillars, That will take us to insurance for all by 2047. And just to repeat, refining the present, that is the new architecture, the regulatory architecture, then leveraging technology and data, third, reaching out to the last mile, and fourth, by being future ready, because we have to also make sure that the sector remains stable at all points of time, the policyholders' funds are protected and kept safe and secure at all points of time. So all of this are going to pave the way for insurance for all by 2047. And I'm pretty confident that with this roadmap, we will be able to reach there.
Certainly, that's a very positive note that we aspire to achieve. But if you look at the sector today, there are about 27 life insurance companies, 25 general insurance companies, 7 health insurance companies. In your understanding, to cater to a population of 1.4 billion people, do you think the sector needs consolidation and larger, insurance companies, lesser and larger insurance companies? Or do you think we need a lot many more insurance companies of different sizes right now?
See, I think it will be a combination of all. The market will churn. There will be eventually consolidation will also happen. The smaller ones who may not achieve the scale despite having been there for a sufficiently long period of time in the market, there could be consolidation. Then at the same time, you will see new players entering into the field because of the strong economic growth of the country, the revamped regulatory architecture, that thirdly, the purchasing power being enhanced, the widening middle class. So all of these are drivers of growth, and it's bound to happen. And we see that there is a lot of interest being evinced by the global investors to come and invest into the in the Indian insurance industry.
Okay, I'll come to the global interest, but before I do that, I just wanted to ask and have your view on one question. Out of 27 life insurance companies today, only 5 are listed on stock exchanges, which means they've gone public. Out of 25 general insurance companies, we just have 2 companies which are listed. What would be your take on insurance companies going out in the public and listing and making people a part of their growth story as well, especially for the companies which have spent some time in the industry and are sizable in terms of the kind of business that they do?
No, I fully agree that, you see, listing would be a natural progression. Once you achieve the scale, size, or the age, you got to list the company, and it should happen. Listing also brings in a lot of benefits in terms of better disclosures, more value for the policyholders, more value for the investors. It would enhance the customer confidence. It would, even open up access to raising more capital, and it would support growth, innovation. So all of that follows with the listing of a company. So the number of companies which are listed, in life we have 4, in general we have 3, in the standalone health insurance space we have 2, and the recent one, I think today, Niva Bupa is getting listed. Then we have 1 reinsurer.
Yes.
So the total number is 10 at the moment. And we are in engagement with the industry that once, the criteria of either the age or the scale criteria, and we are nudging them to go for listing. And I expect that you will see in the coming months and years more companies, going for listing, or at least preparing that roadmap.
Okay, what is the criteria in terms of age? Should it be 10 years, 12 years that the company should consider listing?
No, as I said, age, you also look at the scale, maybe you look at the AUM, what is the total size of the AUM for life insurance. So it's not one or the other, but we will look at all of this and then shortlist that these are the companies which are ready to go. But you also see people, there are companies who haven't attained that age also have gone and listed. So the whole idea is to keep nudging, but those who have attained size, scale, and also the age should go for listing. So that is what we would be doing in the coming future. And we are already started engaging, and we'll have more intense discussions also on that.
Hopeful of that, Chairperson, sir. One question as far as the foreign direct investment in the insurance sector is concerned. Now, when the FDI was raised to 74% from 49%, that did not garner a lot of interest from foreign players. Now, what do you think? What is your view, the regulator's view? on increasing the FDI limit in insurance from 74%? Should it be taken to all the way at 100%? And do you think, are you hopeful that if it is taken to 100%, there will be very strong interest coming from global players to have their own insurance company in India solely by themselves and hence bring a lot of foreign capital?
You see, FDI, obviously we will look at FDI because you need a lot of, this is a capital intensive sector, as you understand clearly, and insurance is not different from the banking or any other sector. Rather, the insurance sector is about 400 to 500 times more leveraged. So now, given that the insurance sector is poised for a substantial growth, and you yourself said in your opening remarks that they are growing at from between 15 and 18% growth annually. And there are certain reports also, there's, I think, the Swiss Re report, which clearly says or forecasts that the insurance premiums in India will rise by more than 7% in real terms over the next 5 years. And that would outperform the global average of 2.4%. And for the emerging markets, it's around, I think, 5%. And for advanced market, 1.7%. So if that is the kind of scale and size in which the Indian market would grow, obviously adequate growth capital will be vital to harness this potential. So therefore, if we depend only on the domestic resources, then the crowding out effect will play out. So therefore, we have to perhaps look at FDI also, and if 100% FDI is allowed, along with the growth capital or the required capital, it will also bring in global expertise, it will bring in, capacity, technology. So all of that will definitely bound to happen. So perhaps this has become the opportune time for, having 100% FDI. So what will help potentially to the 100% is that it will play out in the sense now the players will come with 100% FDI. They can plan their business independently. They can decide on their growth plan. They can decide what kind of business they want to write. They can infuse the capital very promptly and easily because they don't need to depend upon their domestic partner. So all of this will also be a concomitant benefit which will accrue. And therefore, we need to perhaps think about. But however, I'm sure that the government will take a decision on this at the appropriate time.
Chairperson, sir, you've been doing a lot of roadshows overseas as well. When you speak to a lot of these foreign investors and insurance companies, what do they have to say? A couple of things that they have to say in terms of what could a 100% FDI give it to them, which let's say a 74% didn't.
No, that's what I just mentioned. They can plan their businesses independently. So you don't need to search for a domestic partner who would match their expectations. Then they would decide what will be the growth plan. They would bring in the capital as per their own plan and design. So all of that flexibility will come in, and they will be able to, grow the manner in which they intend to grow. So, so that will help by allowing 100% FDI.
Okay. Hopeful of that, and very interesting move if that indeed comes through. I want to ask you one question which is around a news that recently appeared. The group of ministers on GST, suggesting removal of GST when it comes to health insurance as well as term life insurance. Now, especially health insurance as a portfolio to companies, the loss ratios there are increasingly increasing. Even if the GST cut comes through, and the benefits of that GST cut, let's say in a situation, are not passed on to the eventual policy holders, as a regulator, would you nudge and ask insurance companies to give full benefits of the GST cut, a potential GST cut or a removal of GST on health insurance to the eventual policy holders?
I think that we'll be able to react when it happens. But typically, these decisions will happen at the government, considering that whatever cut happens, if it happens, then the benefit passes on to the customer, right? So obviously it could be implementation of the new GST rates sans the ITC, which is the input tax credit. Then the entire benefit passes on to the customer. So I mean, it'll be good for the sector in the sense there may be a big impetus for health and life term. So, however, I'm sure the government will take a decision in the overall interest of the public and also the economy.
Okay. Three most important things, Chairpersons, are awaited in the Indian insurance sector. The first one is, of course, composite insurance license. The next one is risk-based solvency. And the third one is IFRS. Out of these three, composite insurance license is, of course, in the hands of the Parliament in terms of a final approval. But the other two are in the hands of the regulator. I want to understand the timing on these two things. One, do you expect the composite insurance license, the approval for it, to come in the winter session of the Parliament and for it to be applicable from 1st April 2025? And the other two things, IFRS and risk-based solvency, those are in your hands. By when do we see them getting applicable?
So the first question you have yourself answered. So I will not go into that as to when it will happen. So as far as the amendments,
your expectations, sir.
I would expect the moment it comes, it is welcome. The earlier, the better. So that is something will be known to all of us as and when it happens. The second issue regarding the risk-based capital regime and the IFRS, and also I said a risk-based supervision framework, which we are trying to establish for a more robust and resilient risk and prudent risk management framework. So we are in the middle of the journey, in the sense the first qualitative impact study has already been completed as far as the risk-based capital framework is concerned. The results are with us. We have recently had a meeting only 2 days ago, the 11th and 12th, with the life insurers, with the general insurers, and all the reinsurers, to see the results and share the findings of those results. So we are, as I said, in the middle of this journey. We will be looking at a little more deeper into the various kind of risks that were factored in this first QIS. There will be a need to tweak them and bring in new risk parameters as well. And then the QIS 2 will be done sometime in the next 3 to 4 months. And so if I have to indicate a tentative timeline, then probably, I mean, it's not a hard and final one, because this will evolve. This is a very complex process. We need to take all the stakeholders also on board and make sure that the transition is also a smooth one and as painless as possible. But in the long run, we do understand that the risk-based capital regime is a more efficient way of utilization and allocation of capital. So obviously, everybody will benefit in the long run. So the timeline would be for the risk-based capital, a parallel submission could start in the financial year 26 and the full-scale rollout in the financial year 2027. As far as the IFRS is concerned, again, work is in progress. So it is more of a principle-based approach, you would understand and appreciate. So again, what recently we have commenced the gap assessment study. So the experiences were shared in the last 11th and 12th meeting that we had this November. And based on that, further work will start, or is already started. So what we are expecting, again, a very tentative kind of this thing I'm making at this point of time, not hard and fast, that the parallel run should start somewhere in 25, 26. And, the full-scale implementation could happen in the year 27, financial year 27-28. So that is the tentative timelines that we are trying to set for ourselves along with the industry partners. And as far as the risk-based supervision framework is concerned, 25-26 is our target, and somewhere in the financial 25-26, we would like to start rolling out the risk-based supervision framework.
Well, appreciate specifying the timelines for these important reforms. Last couple of questions before we conclude the interaction. The first one, I want to ask you about the reinsurance capacity in India. We just have one domestic homegrown reinsurance company, that is GICRE. And what that does is that a lot of, money, funds from India are still going to cross-border reinsurers outside the borders of the country. Second thing, what has been happening is that insurers are taking more and more, retaining more and more risks on their books. Does the situation of insurers retaining more and more risk because of lack of reinsurance capacity concern the regulator at this point of time? And to get more domestic homegrown reinsurance companies, what's the plan?
Let me first give you a couple of numbers. The premium that we had collected last year, that is financial year 23-24, that is as on March 31st of March 24, was 11.2 lakh crores. 11.2 lakh crores, out of which life was 8.30 lakh crores and non-life 2.90 lakh crores. So against 11.2 lakh crores, around 92,000 crores of rupees can be assigned to the reinsurance also. 93,000 crores of rupees, that's not a small amount, a big amount. This amount is also growing, and the reinsurance market is also growing at around, same 13-14% there, 13-14% here. In in October by 2024, means the first 7 months, we have already earned a premium of about 6.5 lakh crores, registering a growth of about more than 12%. And we are still left with 5 months, and we hope that this momentum will continue. So what I'm trying to say that the reinsurance market will definitely also grow, and with newer risk coverages and a lot of other changes that have been we are witnessing in the market and the manner of discretionary spend, surely and definitely this is going to grow. So more and more reinsurance capacity and support will be required. That's number one. Now, what has the regulator done? The regulator also has taken several steps to completely change the reinsurance landscape. One, from the ease of doing business, and two, also making it more attractive. How? Number one, we have, what we have done is that the cross-border insurers, the FRBs, the entire ecosystem now are allowed to obtain lead terms, and also the placement will also be made commensurate with the courts, and everybody will be allowed. So it's more of a level playing field. So while on one hand we are trying to increase the capacity of the sector, we are also trying to enhance the technical competence, parallelly attracting more number of players, and as I said, ease of doing business, and also a level playing field. So obtaining lead terms, there were certain restrictions we have removed, and also placement, also we have eased considerably, meaning the order of preference which existed earlier for placement of the reinsurance business has been reduced from 6 levels to 4 levels.
Correct.
Today, after the GIC, which is the only domestic reinsurer, all the FRBs and the offices which have been established in IFSCA, Gift City, Gandhinagar, which are called the IIOs, they are at the same footing, because they will invest 100% of the premiums within the country, and therefore they are given the same order of preference, right? So I think now the CBRs, the cross-border reinsurers, will get attracted to come to the Indian market. They will obviously get a better deal if they go to the Gift City IIOs, because there are some additional benefits that they will get. However, they can also come to the domestic tariff area, given the new dispensation that has been provided, both in submission of lead terms and in placement of business, and they are being kept at par as far as the allocation or the placement is concerned in the order of preference. So furthermore, we have also revised the requirement of the capital, the assigned capital. We have brought it down from 100 crores to 50 crores. And furthermore, if there is a surplus capital lying in the Indian entity, then that can be repatriated so that it could be used elsewhere. That flexibility has also been provided, which was being demanded by the reinsurers. Even the regulatory returns and the application process for the FRNs, all of that has been rationalized and made easy to a large extent. So the entire ecosystem has been revamped, and that makes it more attractive for the CBRs to set up offices or shops in the GIFT City or in the DTA. So we feel that going forward and in the months and years to come, we will see more CBRs coming and establishing their shops in India. And that will
Well, hopeful of that happening,
capacity.
because that will absolutely, that will bring in more capital and reduce the risk from the books of insurers as well. Chairperson, sir, one final question before we conclude this interaction. And you've been at that position, and you've initiated so many structural reforms in the sector in the recent past. Your term ends in March 2025. Straightforward asking you this question: if the government is open to offering you an extension when it comes to the position of IRDAI chairperson, would you be open to accepting it and extending your term?
So that's a very, let me tell you that it's been a privilege and an honor to serve in this role, and with a wonderful teamwork at IRDAI and equal measure the response of the stakeholders. I think we have been able to achieve what we have made in the last 24 months. So I think the momentum and the energy will actually propel the future growth. So we have collectively embarked upon the journey towards insurance for all by 2047, and I'm sure that we will be there, and therefore a lot of more work is required to be done. However, at the end of the day, I would say that institution matters, not the persons. So thank you very much, Yash.
Thank you so much to you, of course, to have this interaction with us on an important day. I wish you all the best for, of course, the changes that are in progress. We'll be keenly watching on some of these most important reforms and how they play out on the sector. Thank you so much, and appreciate taking the time out today for this important interaction.
Thank you. I'd like to thank you and the viewers, the audience, for listening to me. Thank you very much.